when you put your money in the bank is the safe custodian of your money, whereas legally, you are a unsecured creditor to the bank. So what most don't understand is that when you deposit money in a bank, you legally have given the bank a loan.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a returning guest who's always been popular with our viewers. John Adams is the chief economist at Good as Gold Australia. He's also a member of In the Interest of the People, a watchdog group that keeps the public interest at front and center in Australia. John, thanks for joining us again this Wednesday, July 15, 2020.
Thanks, mate. How you going?
Very good, thanks. Good to see you again. It's been a long time.
It has.
We had you on not that long ago, though, a few months back, talking about a grave concern you had about the potential for a cash ban in Australia. And now we have another sinister possibility that's on the docket there, that you believe that a recent law that's passed has a loophole that could leave ordinary depositors at risk of bail-ins by the banks, as we had seen in the country of Cyprus in the past and as we've seen happen in other places. There is historical precedent for that. There's recent precedent for it, and there's valid concern that people have wanting to know, when they put their funds in the banking system, are they at risk of those funds being grabbed by banks that get in trouble from doing their risky bets and stock market speculating that they've done and all the derivatives they've got between each other? So could you give us at a very high level what it is that's really got you concerned and fired up now? And I understand you're even submitting testimonies to Parliament about this, and they're responding. You've got connections with mainstream media there that are inquiring about this. You're really, once again, the tip of the spear in the interest of the people there. So what's the big deal about, and why is it important?
Sure. So basically, there has been a big global conversation about this topic called bail-in. And basically what bail-in is when a bank gets into financial trouble, it converts its liabilities into owner's equity. So it basically converts hybrid securities, retail deposits into shares. Obviously, Donegan, you'd be aware that in 2013, this happened with the Bank of Cyprus. So in Cyprus, when they had a financial crisis resulting from the Greek crisis in 2012, that a couple of banks in Cyprus went under, but they decided to save one bank. And the bank they did decide to save was the Bank of Cyprus. And part of what they did that was they got a bailout package from the European Union, but that wasn't enough to save the bank. So they had to conduct a bail-in, which was they confiscated 47.5% of deposits above 100,000 euros and converted that into shares for the depositors. And that's been a horrendous story for those depositors involved with the Bank of Cyprus. So that's what happened in 2013. And so resulting from that, but also going back to say what happened in New York in 2008 with Lehman Brothers, there has been a global effort to limit the financial exposure to taxpayers around saving banks. So with the G20 after the global financial crisis, there was a recognition that if another financial crisis was to ever happen again, the cost to the taxpayer would be quite extreme, and that there had to be other forms of resolving financial insolvency with banks that didn't require central banks and national governments to sign blank checks. So I think, correct me if I'm wrong, with the Congress, I think the bailout in September of 2008 was about $700 billion. And then you obviously had stimulus packages on top, which ran into the trillion. And then you had the US Federal Reserve printing trillions of dollars, anywhere between $15 to $20 trillion to save the financial system. So they said, well, we need a new framework. So there was a series of G20 meetings in 2010, 2014, etc., where the G20 created a sub-entity, which is called the Financial Stability Board, the FSB. And the FSB developed a global framework about how do you resolve banks that get into trouble. And one of the tools they came up with is this power of bail-in. So now the United States, Australia, who's a member of the G20, and a whole bunch of other countries have signed on to this framework. So
can I interrupt for a minute, because I got two things. Sure. One is just to make sure that people are understanding here, and most people I know get this, but for those who are new, what you're actually talking about is that when banks get into trouble, that in order to save the taxpayer and the central banks from having to bail them out, we're just going to let the banks, the rules were changed to let the banks actually take funds that were on deposit there, savings and other deposits that were on there, and just take those as working capital.
Yes, any bank has a number of different forms of liability. So it could be capital notes, it could be hybrid securities, it could be convertible bonds. We're talking about those sort of instruments. And I'm not sure about the United States, but in Australia, so when hybrid securities are supplied to the market, I mean they are clearly labelled as these instruments could be bailed in during a financial crisis, or if the bank was to experience financial difficulty. So there's some transparency on that issue, but there is this issue in terms of what happened with deposits.
Right. That's the other thing I wanted to say, and people have heard this before if they've heard tell my story, but I wanted to say, you mentioned Lehman Brothers in 2008. My wife and I, having been burnt in the dot-com collapse of 2000 and after that, wanted to make sure that we weren't exposed to the volatility of the stock market to the extent that we were. So in approximately 2007, we asked specifically at our brokerage firm, which was TD Ameritrade, and how could we reduce our exposure and still get some decent returns on our cash. And they said, well, instead of just leaving it in this cash equivalent FDIC insured thing where you're getting a fraction of a percent, you could get more than a percent, almost 2% if you put it in this money market fund. That money market fund was called the reserve fund, and when the 2008 collapse happened, we got a notification from our brokerage that we would not have access to our account funds anymore. And we said, until further notice. And we said, what are you talking about? We're in this money market cash equivalent thing. And they said, well, actually, and it took a lot of probing on our part, but they finally said, well, actually, that fund was investing in many things on the back end, and one of it was Lehman Brothers, and they were collaterally damaged from Lehman Brothers went belly up. So you don't have access to your funds until further notice. And it took months and months for us to get partial access. And to this day, here it is, 12 years later, we still do not have all of those funds restored to us. And every year they call us up and say, hey, what can we do for you? Notice you haven't been trading a lot of stocks recently. What can we do for you? I said, well, you can give me my money back. So we are one of the casualties of effectively what was a bail-in because what we thought were safe funds that were not invested in stocks and not even invested in Lehman Brothers got damaged because the bank got into trouble, the brokerage in this case. But I know that's an analogy. It's not exactly what you're onto, but just to realize that this does and can happen.
Sure. Yeah, so with the story you just told, I think there's an important distinction to make. So when a financial institution prevents you from getting your money back, that's technically called a capital control. But bail-in is a specific action where the liability, whether it's a deposit or whether it's a bond or a convertible note or a hybrid security, that is literally converted into shares, and you actually take ownership of the bank. So
no longer do you have your funds anymore. Now, congratulations, you're partial owners of this sick institution with its toxic debt. Okay.
Exactly. So the global framework that was published by the Financial Stability Board, it has a number of key attributes. So key attribute 3.5 basically says that that those signing on to the framework will bail in, and they do use the word bail in. They will bail in creditor claims. Now, who are the creditors to the bank? It includes a whole bunch of secured and unsecured creditors. But one thing that I realized last year as I did a seminar in Adelaide, in Australia, was so most Australians, and again, I'm interested to know what Americans think about this. But in Australia, we grew up with this notion that when you put your money in the bank is the safe custodian of your money, whereas legally, you are a unsecured creditor to the bank. So what most Australians don't understand is that when you deposit money in a bank, you legally have given the bank a loan. Now, so obviously that sort of notion. Obviously, when you read this key attribute 3.5 of bailing in creditor claims, that the way I read that, and some of my colleagues read that is a commitment to this international commitment that Australia has signed on to bailing in retail deposits during a financial crisis. Now, a whole host of so after this framework was agreed to in 2014 by the G20, the G20 members, there was an effort by national governments around the world to implement this framework into domestic law. Now, the law was introduced into federal parliament in Australia in 2017. There was a Senate inquiry about this, and it passed in 2018. Now, at the time, there was a number of groups in Australia that was raising the prospect of deposits being confiscated, just like in Cyprus, and so there was a lot of back and forth about that. Now, the Senate Economics Committee in 2018 came to the view that deposits were safe, there was nothing to see here, and they passed the legislation. So now, during that time, I was not involved in that sort of public debate. So then I come into the scene in late 2018 with my colleague from YouTube, Martin North, and I started digging into this sort of stuff. And so I find a bit of a loophole in the law that, to my mind, would give the government the ability to bail in deposits during a financial crisis. Now, the other interesting thing that I found is because one of the refrains that a lot of Australians would say is, well, don't compare us to Cyprus. I mean, Cyprus is a small country in Europe, a very unsophisticated financial system. It has no relevance to us. So if a bail-in of deposits happened in Cyprus, that should mean nothing for Australia. Well, the reality is that bail-in has already happened in Australia. I mean, this is something that I found at the beginning of 2019, going through the history books. So the biggest depression in Australian history actually happened in 1892, 1893, which was bigger than the 19th. So the 1930s was the biggest for the United States. The biggest depression in Australia was actually in the late 19th century. And during that episode, there was a number of banks in Melbourne, Victoria, that became insolvent, and they actually they went through a bail-in process. Now, that process wasn't called bail-in; it was called reconstruction. And basically, what happened was that they had a bank that was insolvent, and then they created effectively a new structure, a new bank, a new corporate structure, and they took the deposits from the insolvent bank, and they converted those into shares in the new bank. So that bail-in process has actually happened. Now, that was obviously, most Australians have no idea most Australians have no idea about bail-in. No, Australians don't actually understand that bail-in has already happened in Australia. And even my colleague Martin North, I mean, he's a banking expert. He thought the first world example of this was actually Cyprus in 2012-13. And when I actually called him up one evening and I said, I've just been at the university reading the history books, and that's literally where I found it at my local university. I said, it's already happened, and we did a show about it, and we actually quoted there's several quotes that we talked about specific institutions that went through this in the 19th century. So now, whether Australia was the first example of bail-in in Australia, in terms of the world history, we're not sure, but definitely this what happened in Cyprus has happened in Australia, more than 100 years ago. So fast forward to today, a senator in the federal parliament has introduced legislation to close some of the loopholes that me and some of my colleagues found, and the loopholes that I found were never considered by Parliament 2 years ago. So basically, I've come to this saying, we're not trying to relitigate the debate of 2 years ago. We have something new to offer, and obviously, the proposed legislation is worthy because of the new evidence we found. So the legislation was introduced into Parliament in February. And then in June of this year was referred to the Senate Economics Committee for an inquiry. So last week was the last week in which submissions were due. So far there's been about 170 submissions accepted. Now, of all the submissions that are advocating for the law, mine's the most detailed. So 32 pages. I have a couple of letters from a independent solicitor in Sydney that gives his legal opinion about technical aspects of the law. So, whereas our previous conversation was about this $10,000 cash transaction ban, and that was more political because it was about human rights and economic freedom, this debate really comes down to how does the law work in practice? And so part of this challenge has been, particularly dealing with the mainstream media, is to explain to people, okay, the government says there's nothing to see here, but here's how, in a financial crisis, the law can be used to engineer a bail-in. Now, I just had a journalist this morning saying that some would allege that this is a conspiracy theory. I said, no. As a former management consultant, what do management consultants do? And so I used to work for Ernst & Young, so it's one of the big ones. So we do scenario analysis. So under a set of conditions, what happens in that scenario? So, and basically what we're alleging is that so the law is framed in a way today. If we have a financial crisis, can the law be used in a different way compared to what the government's saying? So that's not a conspiracy theory. That's scenario analysis. And so our case has been that there's a loophole. The loophole needs to be closed. The loophole, I don't think, has been acknowledged by the government. And we don't need, to be honest, I don't even know if the government actually realizes that there is a loophole. And so where we're up to now is we're waiting for the committee to go through the submissions. I've called on the committee chair to hold a public hearing. So with the $10,000 cash transaction ban, I think maybe it could have been on the day or during the week where I testified to Parliament about that particular issue. And so what I've said is I want to testify again to actually explain this is how you are supposed to interpret the law. And so this is the obvious concern we have. Now, a couple of points to make. The first one is that the amendments being proposed by Senator Roberts, they are very simple, technical amendments. Now, talking to some of my banking contacts last week, they said that assuming what the government has said, so that the government for 2 years has said on the record, deposits are safe in Australia, nothing to see here. If that is true, there is no reason not to pass the legislation because there is no downside. No one loses anything by passing this proposed law. But if there is something to see here, then you're obviously going to start to see opposition to this new law. And we've already started to see that. So the government submission was published yesterday on the Parliament's website. So we read it. And basically the government is saying this law is unnecessary. So one of the things I've been saying to the mainstream media in the last 24 hours is that the government cannot admit that deposits are at risk. Now, so it could be that the government has misread the law or may not have seen the loophole we've identified. And so if that's a genuine position, then obviously we can have a technical discussion and see if we can work to a consensus. But if the government is actually intending for deposits to be on the table, consistent with our international obligations with the FSB, the reality is they can never admit it, because if Australians realise that their deposits were on the table, it would actually create financial instability, potentially a run on the banks. And so part of the challenge in this process is to say the government is going to testify, if there is testimony, they're going to testify to say, everything is safe. And yet, my argument would be is they can say nothing else because of what it may do to confidence.
Well, could they not go ahead and say, there has been identified a minor loophole that's very unlikely, but just for added security and increased ever so much more safety for the Australian that we're always concerned about, we're going to go this extra mile. I mean, they could certainly spin that in a way that makes it sound really good. Sure.
So that's effectively our argument. Our argument is to say that to give everyone full confidence that what you said for 2 years is actually accurate, that deposits are not at risk, just pass this simple law. What these amendments actually do is, now everyone admits it's common knowledge that bail-in is legal in Australia, but what the government said that you can bail in is certain capital instruments like hybrid securities, capital notes, preference shares, all of that sort of stuff. But they said that deposits in and of itself, that is excluded from this bail-in power. They could easily just pass this to make sure that everything is crystal clear. Everyone can have confidence, and these amendments they basically give exclusions to deposits. So they say you can bail in, you can convert, you can write off capital instruments, but you just can't touch deposits. Yeah. So that's basically what it does. But so far, the government, the Treasury in particular, doesn't want to play ball. And there has been a suggestion by some establishment people that I've spoken to that pretty much the committee has already come to a predetermined outcome, that they're not going to entertain changing the law. But my position is that by passing the law, you establish confidence. By not passing the law, you're going to raise suspicion. And that's pretty much where we're up to. And the committee is due to report back to the full Senate on the 10th of August. So we have about 3.5 weeks to find out, what exactly is going to be coming here in terms of the inquiry process. But we will be seeing some mainstream media articles over the next few days, and so some of the major ones I'm dealing with, and they've been going through my evidence, and that's pretty much where we're up to.
Do you have, in this case, you did, I believe, in the cash ban question, but in this case, do you have any sympathetic members of Parliament that are on the inside of that, or are you entirely limited at this point to working in through this submission process as an outsider?
Probably a couple of points to make. Just for the benefit of your audience, because I think we haven't sort of told people what happened with the cash transaction ban.
Please.
So basically, I testified in that process. The committee came up with a report. Now, the report said change they said there's a number of problems with this cash transaction ban. Change it in several different ways, and then pass it. Now, then when that report happened, then COVID-19 happened, and so the government hasn't done anything. The government hasn't responded to the inquiry report on the cash transaction ban. They haven't said about what their future intentions is. I called the minister's office, I think last week. And I had a chat to one of his advisors, and pretty much the official line is we're still considering the inquiry report, and we'll come back to you and we'll be saying something in due course. And I said, well, so what does due course mean? Is it a month from now, 6 months from now, a year from now? And the advisor says, I can't tell you anything more than that. So we're still in sort of limbo about that issue. But having said that, I think the amount of effort we went to in mobilizing people, that did create the ability for parliamentarians to complain internally. So there was a whole bunch of backbench government MPs that were complaining to the Prime Minister, the Treasurer, and the Assistant Treasurer to say that we're going to suffer political consequences from this. And obviously, because we went through the committee process, I think we presented enough. A lot of good arguments as to why this shouldn't go forward. So even though the committee says pass it after you change a number of things, I think this is not the highest priority for the government, particularly with COVID-19. But even without COVID-19, I think they've come to the realization that it comes at heavy political costs if they were to go down that path. Because even though we had generated a lot of press and we were very public in our interaction with Parliament on that issue, there was still a lot of Australians who had no idea that this was being proposed by the Parliament. So that's what I'd say on that issue. Now, in terms of this issue, the problem with this issue is that because this is very technical. I mean, the reality is, and I'm sure that it's the same thing with Congress. Congress or the Australian Parliament passes enormous numbers of laws. Most members of Parliament don't actually read the law they pass. And so having worked for a senator, having spoken to multiple politicians, I can say categorically that I don't think maybe one or two members of Parliament have an intricate knowledge of this particular law that we're talking about. So, part of our issue is in terms of generating support is the parliamentarians don't have the ability to read the law. I mean, they're not lawyers in a lot of cases. So they haven't done the work. They the people they rely on, which is the Treasury, saying there's nothing to see here. We say there is something to see here, and so part of this challenge is actually trying to educate parliamentarians about, well, do you actually understand the law? Have you read the law? Do you actually understand how this works in practice? And that's a very tough feat. So part of what I tried to do in my submission was to document the full case from the very beginning to the very end, just so that there's no there's no outstanding questions. And so that's what I've tried to do. And obviously, as we go through this process, and so this is one of the reasons why I've asked for a public hearing, is so that I can actually go to the senators and say, okay, these are the specific problems with the law of how this may actually occur in practice. This is why we want to close this loophole by passing this act, and obviously trying to ensure that the senators actually understand what's actually happening here. Because I think most people, it would just go over their head.
Absolutely, and it just makes me think, where would we be if we didn't have some people like you and Martin North that are serving in this watchdog format? So I have two questions about that. One is, what got you into this in the first place?
Well, I mean, the thing is, so back in 2018, I mean, there was a range of economic. So obviously, going back to 2016, I started talking about, the risk of this global debt bubble. I mean, my crusade is basically, I'm a very anti-debt person, both professionally talking about the Australian economy, the global economy, but also personally. So I got onto this thing about, we've got this unsustainable debt problem. It could lead to another financial crisis, and then as you start to get into, well, what sort of financial crisis? What does that mean? What does it mean for the banks, etc.? That I came across this topic in terms of bail-in, etc. So I'm just a curious guy. I started prodding and probing and reading reports and stuff like that, and then I discovered this particular loophole, and then I had contacts in Parliament, and I called one of them up and said, when you told your boss to, so this was an advisor, so I said to this advisor, when you told your boss to vote for this law, did you actually look at this loophole? And I said, we didn't even see it. We missed it. So then I thought to myself, well, that there's something to this. So that's when we did like a 5-part series on with Martin in 2018. We had a lawyer that basically looked at our arguments and thought that there was something to it. And I mean, I have to say, worst comes to worst, assuming that everything I've written in my submission is dead wrong, the government still loses nothing by passing the law. So the proposed law, again, there is no downside to passing it, assuming that deposits are purely safe. So the question is, so they will have to go to this inquiry and say that John Adams' analysis is particularly, it's bogus, and they'll have to explain where in the law did I get my analysis wrong. And the legal opinion that I had, they'll have to say, okay, this lawyer that you're relying on, he's wrong. They'll have to explain in detail why, and obviously, if they can't, then obviously it creates uncertainty, and that's why the law is required.
The second part of my question, after how you got into it, was how is it that you're able to devote the time that it takes to really dig in? You talk about reading in reference libraries at a university and digging into the details of the law that the lawmakers don't have time to read into. So how is it that you're able to do this? Because we need more people doing what you're doing, but most people would just be overwhelmed at the thought of even at the prospect of that. But you've made a mission of it.
Yeah. Well, I mean, yes. So I've got a bit of a unique business model that has allowed me to support my family, but yeah, I have the ability to generate income, and I do have supporters, and I do have people who donate money to help me in terms of continue this work. But I think that the work's important, and obviously I have to say, one of the things that I find particularly curious is how once you, I mean, I think it was Rumsfeld said that the world is run by those who show up. So one of the questions I have to myself is, well, when you do show up, what actually happens? I mean, there's a lot of people on YouTube who may say that the elites have full control of the system and you can't change anything. But I think, I'm always curious to see, well, if I do actually get involved, if I do put in a submission, if I do go testify, what actually happens. I mean, do we still get the same outcome? Does the outcome change? How does this process all work? So part of it is to say, well, can you actually influence world events, or is this all stitched up like a lot of people on YouTube believe?
Good for you, though, for even doing that and doing the hard work that it takes to put yourself out there and to do the research, the networking, the communication, the persistence, the educating of lawmakers, the educating of the popular press, etc., and the educating here, spending the time here to get the word out.
One point I want to make is that, I mean, particularly on this topic of bail-in, I mean, it is not purely academic in the sense that because of the risks around bail-in, around negative interest rates, around the debt bubble, around the strength of financial institutions around the world. I mean, because I've dug into some of these issues and I have a very detailed knowledge of this stuff, I mean, I've actually taken action with my own money. So, I mean, I'm basically out of the banking system. So people say to me, or I get emails from Australians all the time who listen to what I have to say about a range of these topics, and they say, I have my life savings in the bank. How do I protect it?
Right.
Well, I mean, the most elementary question is, by you putting your money in the bank, you have given a loan to the bank. And it doesn't matter who you give the loan to. Dunnigan, if I gave you a loan, implicit in any loan is the risk of default. So it's the risk that you won't get your money back. So if you don't want to give the bank a loan, if you don't want to have that risk of default, take your money out of the bank. And so that's what I've done. So one of the reasons why I've been in the bullion industry for the last couple of years in Australia is because of the need of securing your wealth
outside the banking and financial system.
Of course. So I know that obviously you're working with Miles Franklin, and so part of your motivation and my motivation is around purchasing power with all the money printing. But the other aspect of it is how do you protect yourself against the financial institutions when you see all this stuff like banks failing or banks not giving you money back in terms of capital controls or in terms of confiscation. I mean, look, it's interesting. People in the gold sector love to talk about gold confiscation, and I know you've asked a number of your guests about the risk of either nationalisation around mines or what happened with FDR in 34 in terms of gold confiscation. But yeah, there's another form of confiscation that people need to be aware about, and that is the confiscation of deposits. And I'm not sure if the United States has any sort of history around this bail-in issue in terms of things happening in your history, but I think Cyprus is the modern blueprint of if they're going to do it. This, here's how you actually conduct it. But obviously, in the Australian context, it's happened to us before.
Well, we also had the General Motors and the auto industry, where we had my wife and I saw back then that the auto industry was being distressed. The shares were knocked down to a small fraction of their former value. We bought up some shares of GM at the time, and then Obama did what he did, and they created a new class of stock to put some federal money injection into the company and reincarnated the stock, and ours just became worthless. So there's been a lot of different shenanigans that have happened, and even in addition to the capital controls that happened on our reserve money market fund shares at Waterhouse that was damaged by Lehman Brothers, they eventually converted the remaining missing balance into some kind of shares of something anymore that are still sitting there. So what the heck? Maybe I own part of Lehman Brothers. May it rest in peace. But one of the things that I have as an engineering background for 35 years now before starting this, and one of the ways that we do in engineering is called failure mode effects analysis, FMEA. It was actually developed by NASA in the 70s, although I have a funny story about how I thought I invented it. I actually reinvented it, it looks like. But anyway, so I'm going to be doing a failure mode effects analysis on our financial plight that we find ourselves in as ordinary people. And this would be one perfect example of all the different failure modes you could have that could impact your life. Is bail-in a credible risk? What would be the impact if it happened? What's the likelihood that it could happen? How would you detect it? How would you prevent it? How do you mitigate that risk? And how does that assign that a risk priority number just like any other risk, and see if it's something you should be taking actions to mitigate. So I'll be on that from the U.S. side. I'd love to compare notes with you along the way. You could probably review some of my rough draft and think of a lot of examples that I'm not thinking of as far as risks to the ordinary person, but it's something that I can offer coming from that engineering background, and maybe with the combination of our two differing backgrounds, we could bring a more full dimension perspective to that. I really would appreciate that collaboration.
Sure, not a problem.
So it sounds like the cash ban question is on hold until sometime in the future.
Yeah.
In due time or whatever. And so we're going to let you alert us to if you see movement on that again. Just glad for your presence there, for your vigilance, as I guess an outspoken critic of those who would pull the wool over the ordinary person's eyes and keeping a watch out for people down under. We always appreciate your visits here, and just thank you for joining us on Liberty and Finance. If people want to find more about your work, where should they go?
So I have a website, adamseconomics.com. It has all my work. A lot of articles that I've published about all sorts of economic and financial topics. If people want to actually read my detailed submission that I've submitted to Parliament, I mean, it was actually published on the Parliamentary website yesterday, but people can just email me at john@adamseconomics.com and basically say, can you send me your full 32-page submission, and I'm happy to share it with people.
John Adams, thank you for joining us again here on Liberty and Finance.
Thank you very much.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs or increase your acquisition of physical precious metals now and protect your family's future starting today.